Investors continue to digest the latest jobs data. Our next guest is keeping an eye on global growth, which he says looks weak, particularly in a market like Canada, in which mortgage resets could have a negative economic impact. David Aspell is Co-Chief Investment Officer at Mount Lucas Investment Management. David, thanks a lot for joining us. What do you see in the Canadian economy? We just had a jobs report this morning that, while it showed a big increase in aggregate employment, showed a very large increase in the rate of unemployment, and that has the fixed income market placing heavier bets on a 50 basis point rate cut later this month.
Yeah, thanks for having me. Yeah, I mean, Canada looks pretty weak, I think. As you say, the headline employment number is a little better, but it's quite a large jump in the unemployment rate. It's at cycle highs. It's been, it's generally been going up in a straight line for over a year or so now, and they've started to cut, and it seems like they need to continue to cut quite aggressively. The way that the Canadian mortgage market works, at least relative to somewhere like the US, means that the rate hikes seem like they had more of an impact and slowed things down quicker than the US, and you need to be able to deal with that.
What about the global economy? What do you see ahead for 2025?
Yeah, I think the incoming administration in the US is inheriting an economy that is fine-ish. It's slowing down. It's clearly got some issues in the interest rate sensitive sectors, housing in particular. There's some slowing employment growth. I mean, today's print was good. It certainly got rid of some of the fears from the last month's print, but overall it's slowed fairly significantly, particularly on the private side. And now you've got mortgage rates that were flirting back with the highs. So I think the incoming administration has got quite a lot to contend with. I think the main issue is going to be how quickly the positive vibes that you're seeing from businesses on the back of the election, partly due to the likely continuation of some of the tax packages, how quickly that boosts sentiment and hiring.
China, what do you see in China? In recent months, we've had more efforts by the Chinese authorities to stimulate not only the Chinese economy, but the Chinese stock market. How much of a story will that be in 2025?
I think it's a huge story. Yeah, I mean, clearly that economy has issues. It's slowing quite aggressively, or has slowed quite aggressively. And the administration there are trying to do things to kickstart sentiment. It's obviously very difficult, particularly given the uncertainty that you've got with the incoming Trump administration. Again, you don't know how tariffs are going to play out. You don't know what the environment is going to look like. If I were them, and I think this is broadly what they are doing, they are trying to stimulate. They've cut rates a lot. They're doing a lot of things around the mortgage market. They're trying to stimulate, and I actually think that what they've done so far is quite large and will be enough by itself. But the stock market, I guess, doesn't agree currently. Bond yields there are collapsing still. I think what the market's looking for is much more direct fiscal stimulus, that you can cut rates. Which is one side of the equation. They've done that, but if the lesson from the US over the last few years is, if you really want to turbocharge activity, direct fiscal stimulus is really powerful, and I think we're going to see more of that. And for 2025, I think that is going to be one of the largest story out there, which will be how well does China manage to stimulate, and how does it interact with the rest of the world, given their economic model is out of favor with other people currently.
And how much of a wild card is that in the commodities story? Commodities like copper, for instance, which is very sensitive to perceptions of global economic growth.
Yeah, very sensitive to it now. I think the issue, if you zoom out a little, the issue that China has is that they've spent the last 20 years investing largely in real estate and infrastructure, which is very copper sensitive. What they really need to do, and I think they understand, is they need to increase the domestic side of consumption and get people spending and people consuming more services, so that they're not continually overproducing and having to export those surpluses to the rest of the world. So I think for copper and commodity prices, it really depends the manner in which they choose to stimulate. If anything, I'd rather that they did more direct fiscal stimulus on the consumer side to raise consumption. Whether they're able to do that, generally the playbook in the past has been to stimulate investment, which I don't really need more of. And if they did more of the investment-related stimulus, I think that would be much more bullish for things like copper. On the consumption side, I think it would be other commodities, likely around foodstuffs and meats, those kind of things. I think it'll be a big issue for commodity markets.
David, thank you for joining us.